Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Bark stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Bark is a subscription-based service that mails customers a box of dog products each month. It has over 1.8 million active subscriptions from BarkBox and Super Chewer. It allows owners to personalize the boxes with over 200,000 combinations. Each BarkBox has at least 2 toys, 2 treats, and a chew, all based on a monthly theme. I used to receive BarkBox. I was a member for 6 months, but I stopped because I didn't know what to do with all the toys. The company launched BarkCam in 2014. This is a photo sharing app similar to Instagram for dogs. Bark Bright was launched in 2019, offering a gel toothpaste and dental chew. Bright Dental received a mention in Time Magazine's Best Inventions. Bark Eats is a dog food delivery service launched in March 2020. Bark Buddy is similar to Tinder but for dogs. Users can swipe left or right depending on their level of interest in the dog. It is a free app designed to match humans with dogs up for adoption at nearby shelters. Users can filter by gender, location, activity level, age, and size. The app is connected to rescue centers and shelters across the US and Canada. There are 300,000 dogs in the database. In 2017, it launched Super Chewer to address the needs of larger dogs and dogs who love to chew. Super Chewer delivers toys each month that are designed to be very durable. The company offers products in more than 23,000 retail stores. It has marketing partnerships with Subaru, Dunkin' Donuts, Costco, CVS, and many more companies. Matt Meeker is one of the co-founders of Bark. He was also the co-founder of Meetup.com. Bark was funded by a SPAC, a special purpose acquisition company, is formed to raise money through an IPO, then acquire a private business to help them go public. In December 2020, the merger was completed and Bark received $250 million in cash proceeds. The SPAC that acquired Bark was Northern Star Acquisition Corp. Northern Star's enterprise value of Bark was $1.6 billion. Enterprise value is market cap plus net debt. The company is headquartered in New York, and was founded in 2012. It trades on the New York Stock Exchange. Let's get started with the model. This is a small cap company, 1.1 billion market cap. They're trading at $6.62 a share, and they have 168 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. I don't have too much financial information on this company since they recently went public. The only complete financial information I have is the second quarter of 2021 versus the second quarter of 2020. So some of this information I had to infer from their presentations and other reporting items. So they have negative free cash flow in 2020 and 2021. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was $8 million in 2020, negative $31 million in 2021. Revenue is the sales for the company, and they have pretty strong revenue, $224 million up to $379 million. This is the company's income statement. The top line is the revenue, the sales, and this income statement is comparing the second quarter of 2021 versus the second quarter of 2020. Here's a breakdown of their revenue. $105 million of the $118 million is direct to customer. These are the monthly subscriptions. $12.2 million is sales to retail stores like Costco and Target. Revenue from both categories increased quite a bit from the same time period last year. Below revenue is cost of revenue. These are cost of supplies and cost of labor. Below that is their gross profit, which went up from $47 million to $70 million. Then below that is general and administrative expenses. This is payroll, rent, insurance. Then below that is marketing and advertising. Their total operating expenses are $87 million, which is double from last year. Since their operating expenses are higher than their gross profit, they have negative operating income. It was positive $3.3 million in the same quarter last year. This is pretty typical with a company that's looking to grow its brand. Sometimes you sacrifice profits in the early years for more revenue growth in future years. Below that is the interest they paid on their debt. They paid $1.6 million of interest in the second quarter. Below that, they had a $6.4 million loss in other. And for the quarter, they had a $25 million net loss. And it was a $2 million profit in the prior period last year. This is the cash flow from operating section in the statement of cash flows. Cash flow from operations is like net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So in the second quarter of 2020, they generated $1.5 million of cash flow. In 2021, they had a $62 million deficit. And the way you calculate CFO, you start with net income, that was negative $25 million. Then you add back the non-cash items on the income statement. And then you add or subtract changes in working capital. So they bought a lot of inventory in the second quarter, $25 million. So that's a cash outflow. But when they use the inventory, it'll be a cash inflow and improve that cash in that period. They paid $14 million of accounts payable. So they probably bought inventory on credit in prior years and they're paying for it in this quarter. And they had a cash outflow of $12 million in other liabilities. These are more timing items, changes in working capital. There are a lot of companies, if you look at their third quarter cash flow from operations section, it looks like they have a huge cash outflow and it looks like the company may be struggling. But then if you look at the same company's fourth quarter, it looks like they had a huge cash inflow and it looks like they're doing amazing. How could one quarter look like the company's headed towards bankruptcy and the next quarter the company's prospering? Because you have to combine all the quarters together and you get the whole picture. In the third quarter, a lot of companies are buying up inventory for the holiday season. And in the fourth quarter, they sell all that inventory and the cash comes in. If you're not too comfortable reading through the cash flow from operations section, the company talks about it in a little more detail below this report. It says the decrease in our operating assets and liabilities was driven by the changes in the inventory of $24.9 billion to support current demand. So demand was high, so they had to buy a lot of inventory. Accounts payable and accrued expenses of $13.7 million related to increased expenditures to support general business growth. So they had to pay these past accounts payables to support the growth of the company. Also, this relates to the timing of payments. I mentioned this a lot in my videos. Changes in working capital is a lot about timing. Like that example I gave you earlier about the inventory. Let's look at the capital structure. They raised $446 million from selling their business. So even though they brought in $250 million from the IPO, it looks like they brought in $200 million before that as well. So they raised nearly $450 million from selling their business. And they took that money and lost $205 million. But this happens in the early years. Companies invest a lot into their business to grow it. The hope is they'll become really profitable in the future and this accumulated deficit will go to zero and become positive. Because if you're investing in a company, you don't want them just to have losses. You want them to eventually become really profitable. If you think this company is on the path for profitability, it would probably be a good buy. But if you don't see that happening, you see them struggling for a long time, then it's probably better not to buy the stock. Let's look at the capital structure. They have $242 million of equity, $72 million of debt. They're 77% equity, 23% debt. And their net debt is negative $249 million. So they could pay off all the debt with the cash on their balance sheet and still have $249 million of cash left over. And their highest WACC according to Finbox is 9.3%. And that's the WACC I'm going to use for this model. And that's a discount rate we're going to apply to the future cash flows. We estimated 6 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 6, that's $2.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.6 billion. We divide that by 168 million shares. And we get a calculated stock price of $9.50. They're trading at $6.62, so they're trading at a 30% discount. It's a buy according to the model. The company reported their annual revenue in one of their presentations. So I took their 2020 and 2021 actual revenue. For 2022 and 2023, I also took their revenue expectations. And the average analyst projects their revenue to grow 26%. So I grew their revenue 26% for the next few years. That's how I got all their future revenue estimates. I figured they would have negative free cash flow up through 2026. I grew that negative up through 2023, peaking at negative $72 million. Then I tapered it down the next few years. And the way I got their future free cash flows for 2027, I noticed in all my videos, the average company converts 10% of their revenue to free cash flow. So I just multiplied their revenue estimate for 2027 by 10%. That's how I got their future free cash flow. This is the stock price so far in 2021. So you can see it's done really poorly. In the very beginning of the year, it was about $18 a share, and now it's down to about 1/3 of that. And it's good to compare the stock against other companies or the index, just to see how it really did. And the S&P is up 22% so far in 2021, while this stock is down 56%. This chart shows 3 other companies in its industry, even though they do something totally different than this company. I don't believe there's any public company that does what this company does. Monthly dog boxes. Car Lots is down 70%, Bed Bath & Beyond is down 44%, and Envela Corp, I'm not too familiar with them, they're down 18%. So within its industry, the company is pretty comparable. The 52-week range for this stock was $6.07 up to almost $20. And the stock is trading pretty close to its all-time low at $6.61. 3 analysts priced this stock and the average price target was $15.33. The low was $14, the high was $16. So all are saying the stock is undervalued. And all 3 analysts rated a buy. We all know the pet market is huge. We love our pets. $120 billion is spent throughout the entire world, $50 billion in the US. And this industry hasn't entered the 21st century like other industries have. Like Uber took over the taxi business. There used to be inefficient taxis. Now we have Uber and Lyft. Same thing with Netflix. They took over video stores. Now this company is going to try to take over pet stores. In the first quarter of 2020, they sent out 1.8 million boxes. In the fourth quarter of 2021, they sent out 3.5 billion. So they nearly doubled in 2 years. Plus the average order volume is also increasing from 26 to 29. They're doing a good job upselling their clients. Because you could start out with a $23 box, but then there's other options to buy different products. You can buy food or toys or clothing. The stock is down 46% in the past 52 weeks, while the S&P is up 40%. The low was $6, the high was $20. And the stock is trading below its 50-day and 200-day moving average. 1.8 million shares have been traded on average each day for the past 3 months. Of the 168 million shares outstanding, 157 million are on float. Half are held by institutions, and over 10% of the shares on float are shorted, 7% of the total shares. The short percentage keeps going up even though the stock price is coming down. A lot of SPACs have really struggled. They start out really high, going past the $10 original price, and then they slowly drift down the following year. That seems to be a common trend with a lot of SPACs. If you put $10,000 into this company when it was trading as a SPAC, your investment would be half right now. The biggest shareholder is Fidelity. Then one of the founders owns 6.5%. Founders Circle owns 5%. Vanguard and ProShare. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price to sales looks pretty good at 2.9. That's the market median. Price to sales is stock price over sales per share. So investors are paying about $3 for a $1 revenue. But that's actually not a good price to sales ratio for what they do, because they try to sell in bulk, so their margins are lower with higher sales. When you sell specialized products, like really fancy jewelry, you sell a lot less of those products, but your margins are a lot higher. I'll show you later when we compare their ratios to other companies in the industry. Their price to book is decent at 4.6. The only reason it's that good is because of all that cash they raised from the IPO, but they do have a good amount of current liabilities on their balance sheet. They have a high current ratio of 3.1, a high quick ratio of 2.4. They have $320 million of cash on their balance sheet and $102 million of inventory. So at any given time, they're going to always have a lot of inventory on their balance sheet, because they're constantly buying and moving product all the time. So they're well capitalized due to the IPO. Even though they lost $8 million in free cash flow in 2021, they have nearly $300 million of working capital. Working capital is current assets minus current liabilities. So they have $287 million of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 13 companies in the same industry as Bark, and if Bark has number in red, they're worse than the average. If they have number in blue, they're better than the average. So they're worse in price to sales and price to earnings. They have one of the worst price to sales ratios in this industry. You can see a lot of companies are below 1. And their price to book is a lot better than the average. They have a high current ratio. They have negative ROE since they have negative earnings. They're lower than the average company in debt. And they're a pretty small company, 1.1 billion market cap. The average is over 7 billion. So to summarize, I have them trading at a 30% discount. A good way to make money on a SPAC is to buy it at $10. And there always seems to be a major run-up. So you gotta sell it before the crash. If you're a swing trader, that's what you would do. But if you're a long-term trader, then you would probably want to wait a little while for the stock price to come down below the $10 mark and then buy it there. But it could take a few years for the stock price to come back up. I do think they have a really good business model and they have a good future. Even if you're confident about a company, you need millions of other investors to feel the same way as you do. I rank their free cash flow as 1 out of 10, their revenue 7 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.